Hey everybody, this is Don. We'll be starting in a couple of minutes here. We're using GoToWebinar instead of GoToMeeting this time. If you can hear me, go ahead and type in the chat window, please.
So again, the agenda, educational purposes only. I did start recording. Thanks for reminding me, a couple of you. And you will get an archive at the end of the close. So as far as the state of the market, yesterday a big level was broken on the NASDAQ 100. That was 189. And S&P 500, we got down today to 2952. So that's just at the top of the support area. Now what I'm watching to see is if 2980 will, which was temporary broken support yesterday, to see if that acts as resistance on the way back up. Over here in the trend gauge, you can see short-term and medium-term, for the most part, we are still above the 50-day moving average. Short-term, we get another close underneath it today. On some of the indexes, this will go off of a +1. Longer term, still neutral. The flat moving averages is part of the problem. That tells you that you're not in an uptrend. It tells you that you're really in a long consolidation. If you go back, we're up maybe 2% over the last year. When we bring up the charts longer term, this will jump out to anybody. Also take a look when I bring up my quote screen, and we'll go through charts of the major asset classes, take a look at some secondary indicators, and then buy and sell rules is the educational focus today. I want to talk about how psychology needs to change when the chart changes. When something is in a strong uptrend, it's so easy to always think that all pullbacks are going to be bought. And when that stops happening, it's very easy to go to a hope mentality where you're hoping the uptrend is going to be resumed, but you have to face the fact that uptrends stop at some point, especially in leading stocks, because there's always rotation taking place. And we'll talk about, I'm going to show some examples of using the 21-day exponential moving average to cement the fact that an uptrend is coming to an end, at least on an intermediate term. And then using stochastics, Tim, this is very similar to the ATRs that Tim uses. We've been sharing some things that I look at and what he looks at, and there's a lot of overlap with them. But basically, you're looking for, we're always looking for low risk entry points, and that goes as to timing the price entry too. We'll take a look at some charts of what we own in-house, and then I'll take some Q&A and charts on request. So let's look at what I'm watching today. This is the usual quote screen that I keep up. A couple of this. First of all, this BILZF. My son, who's in college, follows this guy named Dan Bilzerian, and the guy is he has a company, and his pot stock company just went. Started trading on U.S. exchanges, and a lot of people got sucked into it yesterday and have lost now 60% of their money. I tried to explain to him, he has this Bilzerian guy really has nothing to differentiate himself except his name from other pot stocks. Pot stocks are in a downtrend, and a lot of hot money will chase it. And that hot money, this got up to $4 yesterday. It's $1.62 today. So hopefully my son learned a lesson on that. No, he didn't put any of his money into it. So that's the broad watch list. Let's go to some charts now. And feel free, if you have questions, to type them into the chat window, not the chat window, the question window. I've got a list open, and I can see if people are adding things. So here's another alert I got today. GDX, you can see breaking this 50-day moving average now. So that's something we're keeping an eye on. Still have some gains in this from when it was re-entered. And this is another example of stochastics coming off oversold. Good timing, good low risk entry when it's coming up through a moving average. In this case, the green is the 21 EMA, the red is the 50 EMA. and coming up through it with stochastics, it's a good low risk entry. We realize that not every entry is going to work, but if you get stopped out, you get stopped out on a very minimal loss for this. So let's go to the indexes. Here's the S&P 500. The red line, the key level here, let me bring up a 60-minute chart. It'll be very evident here. Here's this 2940 area that was resistance for such a long period of time, finally got broken out on this gap. And pullbacks have been around this 2960 and today this 2950 area. 2950 also coincides, if you go back to the daily chart, with the 50-day moving average. So for now, a test of the 50-day moving average has held, and we're actually creeping back above the 21-day exponential moving average, which was also, we had a first close below it yesterday. That's why we've got a rule that we want to see 2 closes below the 21 to signal a change in trend. If we get back above it, then the false breakdown yesterday didn't even happen. RSP, this is the equal weighted S&P 500 that's owned in Grotection. Same situation, a close below the 21 yesterday, sitting right on it now, testing a hold of the 50-day moving average. You will note the stochastic had rolled over at the top today. I'm going to do, as part of the education, talk a little bit about what this actually represents. It's a momentum oscillator, compares the current price to what the price has been over a last number of sessions, and also what the range has been over those sessions. NASDAQ 100, bring up the 60-minute chart. You can see this 189 area, which coincided with the 2940 breakout area on the S&P 500. Tested it here early in the month and held, broke through it yesterday. Now, can we get back above it? You can see I've got an alert set here at 189. Want to see what happens when we get back to that area, because you'll see in an example when I bring up Netflix here in a little while, just the opposite. When Netflix support changed to resistance, we had just been unable to get back above it. And that's also an example of psychology. Netflix, everybody's got Netflix, but their growth is slowing and competition is coming in, and they've got a huge debts on their balance sheet because of all the original content. So you just can't ignore some things like that. Dow Jones Industrial Average, money had been flowing into here recently. You can see relative strength with the uptick as it's more defensive. Test and hold of the 21-day exponential moving average. Again, the green line, very nice. And if you go to the 60-minute, you can see it's still well above. This 26.4 area was the breakout area that corresponded to 2940 on the S&P, and consolidating very nicely above that level. Now, small caps. We're all aware money flowed into small caps, especially small cap value on 910 and 911. All it's done is give it back on, for the most part, lighter volume, heavier volume yesterday, but it's pulled back right to the 50-day moving average and the 21, and you've also got that black line, the 200-day moving average. So multiple levels of support here. The stochastic rolled over. That's not necessarily a sell signal when you're trending okay. And this exhibiting some leadership qualities from a relative strength standpoint, and all the money flowing into it, especially small value. It'll be bullish if this holds, this confluence of moving averages here. And finally, mid caps. This is MDY. Same situation, a little more healthy than small caps, holding the 50-day moving average above the 200-day moving average, and 350 is a key area for mid caps, which was undercut yesterday, reclaimed it by the close, and now getting back above the 21-day exponential moving average. As far as 8 broad asset classes go, I'm going to go by the ETFs that we own in our Robotection portfolio. That's a portfolio that just doesn't own individual stocks. It owns ETFs in 8 broad asset classes. It's our answer to robo advisors that split you into major asset classes and tell you to stay all in all the time. We get into those asset classes, but we've got stops if they get hit. So VOO, still in this. Normally we hold these in different amounts as long as it's trending above the 200-day moving average, which we are in this case. Foreign stocks VXUS, we got stopped out on this when we broke back below the 200-day moving average back here. We've got a standby buy signal on this if this test of the 200-day moving average holds. You can see a little bit of relative strength on foreign stocks peaking in recently. Emerging markets, very similar chart. We got stopped out on this when it broke the 200-day moving average back here. Tested the 200-day and failed. So here's another example of something that is broken support turning into resistance on the way back up. So this is slightly weaker than VXUS, so we haven't gotten our entry signal back in to emerging markets. Bonds, we're long bonds because they're trending nicely above their 200-day moving average. So that asset class is long in the Robotection portfolio. GLD, we are also long GLD from this gap up and move above its moving averages. So we've got some gains in that. XLE, another broad asset class, no position here. You can see, look how the 200-day moving average has acted as resistance every time it's gotten near it. That one big oil day after the Saudi Arabia drone attack, we gapped above it, but we've given that all back up, so below the 200-day moving average on XLE. And finally, XLRE, we do have a long position in this and have held it for a long period of time as this trends nicely above the 200-day moving average. So those are the broad asset classes for Robotection. Let's take a look at the secondary indicators that I follow. Start with the Fear and Greed Index. We got down to a 50 yesterday. Actually mid-50s after being in the 60 area for this, but this is something that follows the market nicely. And when you're down in here and you get a buy signal on some other indicators on the indexes, it gives you the confidence to put money to work. On the other hand, if you're over here in the extreme greed side, you don't really, you hopefully have all of your portfolio allocated at this point because you're just asking for this to slingshot back to the other side. This is people's fear and greed on display. CBO, put call, a little bit elevated today. Tim talked in the video last night about how the 10-day moving average is below where he would want to see as far as being able to be a signal for putting some kind of a bottom in. But again, something we monitor, secondary indicator. We're trying to put the odds in our favor when we follow these indicators. McClellan summation index. This is for the NASDAQ, and this is another indicator that's a matter of is the wind at your back or the wind in your face. We've been overbought for a while in it, so this moved very similar to the way the Fear and Greed Index did. We had a hook down yesterday. Sometimes when you get the hook down, it's a false move. Sometimes it's not. We don't seem to be able to get back above that 2980 area today, and if we give the gains up by the end of the day, this will fall further down, and then if it breaks below the 70 area, that indicates we're coming off of overbought, and very similar to stochastics, it can fall very quickly, and usually the market is falling along with it. So that's the three of the four that I always keep my eye on. And finally, the VIX. These impeachment hearings got us inverted across one of the months in the term structure yesterday, but this still is acting as a tailwind for the bulls. Been getting some questions about this impeachment. People saying when Clinton was impeached, the market did this, the market did that. We're just going to go by the charts. There's a lot of psychology that goes into it. There's a lot of knee-jerk reactions that go by the headlines, but trends persist. If a trend is broken, it'll be broken over short term, then under intermediate term, and then under long term. And that's what ultimately we do, is not going by our emotions. We're trying to stick with what the charts are showing us, not necessarily what the headlines are doing. But we know that between China, between Iran, between oil, and now supposed impeachment hearings coming lot going on in the news, but try to keep our wits about us by going by what the charts are telling us. So psychology. One of the hardest things is when, and let's take a look at this quick. I've always got alerts set. So Nike, after it had its gap up and after it persists for a little while through the day, I set an alert at the high and at the low end of the day. Nike just broke the 91.20, the low from the first couple of hours of trading. So always want to see, and this is very common, what happens when things gap up. Are they going to hold on to that gap, or are they going to give it up? In the type of market that we've had lately, it's very rare that gaps continue their trend higher. Breakouts just don't work in a consolidating market or a market that's under pressure. So when you see something break out, we want to keep track of what's happening. Again, that's fear and greed on display. So psychology, and I'm going to show a couple of charts here relatives to the stochastics and to the 21-day exponential moving average. A leading ETF, a leading group during the first half of the year very clearly was the software group. This is IGV. We identified the relative strength in this during the November-December sell-off. Look at how the relative strength in this group continued to go up while price was coming down. This is what the market was doing. You can see this big sell-off. This is the S&P 500, the big sell-off. But software stocks were holding up longer, and they had the growth recipe to be a leader. And it certainly was a leading group. Now, during the run-up, you had some days where software stocks really got hit. There were 3 days in particular. One was March 4th, one was April 4th. But notice they always held the uptrending 21-day exponential moving average during this uptrend until this base formed during the sell-off, the vicious sell-off in May. We got hit a couple more times during this sell-off that started again in late July, early August. But here's how the behavior changed in the software stocks. Every time it tried to rally back up, it was unable to get decisively above the 21-day exponential moving average. And when it did, it ran into the 50-day moving average, and there was no further price progress. So even as, now look at this black line here, even as the S&P 500 came out of the correction and continued to recover, the relative strength of the software stock continued to decline, and it could not get above this 21-day exponential moving average. And the sell-off in individual stocks that make up this ETF, IGV, and also CLOU, this is a pretty new one. Kind of funny, it comes out after the big run. You can see that this is at all-time lows now. So down from 17 to the mid-14s, but stocks like Twilio have just really gotten completely taken apart from 50 down to 100. That's a 33% sell-off. You have to understand the psychology behind not all leaders work, and you've got to have sell rules in place, and you've got to know when to be able to get out of it. Adobe is another classic example. This has been a leader for a long time, formed this nice base after the correction broke out, but then selling hit it in late July or early August, and it was not able to get back above this 21-day declining exponential moving average. And this is why Tim and I pay so much attention to what the 21 is doing. And then finally you see the 50-day moving average roll over again, and this is sitting right on the 200-day moving average. And now you want to see very often value managers will come in and scoop this up at the 200-day moving average. That's where they tend to buy. But the 200-day moving average, you know, we've talked about it forever. The stats back us up about what a big difference the 200-day makes between when you're above it being bullish and whether you're below it being bearish. But everything going into, remember, the rally recovering, stochastic unable to make any progress, price unable to make any progress, relative strength unable to make any progress, and we've pretty much been out of software stocks for weeks now. And it really is, you have to change your psychology when these things start rolling over from I hope it recovers and I can get back to X, Y, or Z level, to I need to look to get out as much as I can. It goes from a sell weakness to a sell any strength situation. So anytime this bounced up near the 21 day, that was really your time to pull the ripcord and get out, because all it's continued to do is make lower highs and lower lows. And no better demonstration than Netflix, which really came apart after its last earnings report when they reported slowing growth. So take a look at Netflix and focus on this black 200-day moving average here. Netflix came off the bottom very strongly in late December, went from this big run from the low 200s all the way up to 370, riding the 21-day the entire way up. Anytime it tested it, it held. Look at all these holds, tests and holds of the 200-day moving average. We got one here in February, another one here in March, another one here in April. Now the 21 starts to roll over, and notice relative strength starting to decline. 341, it tested again. 332, it tested again in June. Then the last little burst of buying took place before it finally rolled over again. And then a big gap down in earnings, this area right here. And then what happened when it tried to rally up? This 200-day moving average that served as as support the entire time during its run in 2019 turns into resistance, and now it's just continuing to trend lower and lower. And notice the slope of the 21-day exponential moving average. Every time it comes up and runs into it, it fails, and now making lows going all the way back to late December. So any gains that you made from late December, if you were still holding on to this, I got some questions on this one during the last webinar, but this was a very clear sell on this break below the 200-day moving average. And then especially their last chance to get out was this test of the overhead 200-day, which failed. Yes, the market was correcting the same time, but when the market came out of its correction in this period here, you still see relative strength declining, and it can't get above the 21-day exponential moving average. If you love Netflix, and I know a lot of people do, and you want to get back into it, that's totally your decision. But the first thing should be is a flattening out and price getting back above the 21-day exponential moving average. At least instead of guessing or catching a falling knife, you've got an objective level that you're working against. But for now, and they report earnings in 4 weeks, but for now, all you've got is a stock that's extremely weak. Some other examples, let's look at Roku. Man, this was of course, doing a webinar, we want MarketSmith to act slow, right? Roku was, even during the correction, this is one of the stocks. So here again, you've got the S&P 500. So here's this big choppy correction that was going on. In the midst of it, Roku gapped up on a very strong earnings report and just continued to trend higher. Now everybody's piling into it. Everybody's excited. It breaks the top of, look at the slope of this uptrend, and then finally it busts above it. This was kind of the last hurrah. And then on 9.7-ish, 9.9-ish, this big outside reversal and gap down. Came down, held its 21 for a while, but notice the 21 starting to flatten and roll over, and then it got a big downgrade on this day when it breaks below the 21, held the 50 for 2 days, now all the way down to the 100 level. So this stock went from 176 to 100 in a course of 2.5 weeks, and that is just brutal. It may hold this Livermore. You see I've got Jesse Livermore 100 area, which is also support prior to the breakout. May hold it, it may not hold it. But this is a broken stock right now, and again, it's a situation where you have to go from, but I love the Roku story, I love my Roku, I use it every night, to what is price actually telling me? And Roku may continue to be a big winner. Then again, it may not. I don't know, you don't know. We'll get maybe it's next earnings report. Now there is a story. People always say that Roku is a commodity, and that may be the case from just being able to access streaming content instead of cable. But what you have to understand is that Roku also is on the cutting edge of targeted video ads. Normally, when big companies put ads, they put them out on broadcast. They don't know who's watching. They don't care who's watching. Roku is tracking who's watching what, and it gives you the ability, very similar to Facebook, to say who is watching what, and to be able to tailor the ad to a specific audience. So one, you pay less because it's going to less people, but the payoff is bigger and better because it's going to people that are more likely to buy your product. So that's one way from my research that Roku is set apart from some of these other services. But really, the price and volume action and what happens during their next earnings report. Streaming video and targeted video ads is going to be huge over the next decade, and Roku's well positioned to take care of it. But for now, the price broke hard, and you've got to have your sell rules in place to be able to protect your gains. Otherwise, what's the sense in owning this at 100, seeing it gap up, seeing it run 75%, and then giving it all back in a couple of weeks? And again, that gets down to the psychology of it. Another psychology level to talk about here, these charts are really slow today. In fact, I'm going to shut this down and restart it. I may just be streaming too much data. So let's take one last look at the watch list while I recover my charts. Not much has changed from when we were looking at it before. Still vacillating this 2970 to 2980 area. The key level that I mentioned I'm watching is 2980. Can we get back above it on the S&P? And can we get back above 189 on the NASDAQ 100? And this streams a lot of data, so I'm going to shut this down. That may be slowing down MarketSmith. So, okay, there's Roku. GH, this was something that we owned in the Grotection portfolio. Had a nice gap up here. We owned it going into earnings. Gapped up, everything's great, right? Well, not so much. The market, again, always look at what's the market doing. You can see it's going through this correction period right now. Pulls back, holds the 21, everything's fine now, but now breaks the 21 and starts to roll over. Here's where I got out of my position. This was such a rosy report on GH. They upped their guidance. Sometimes that's not enough. You have to go with the price and volume action. And so getting out here in the low 90s, this stock is all the way down to 67 now, and now breaking the 200-day moving average. Still a great story, still a great product. Huge sales growth, 189%, 179%. They still lose money though. So it is a growth story, but you can see once the relative strength starts to roll over, the 21 starts to roll over, and you can't get out of oversold area. You just got to get out of the way. And then another example of psychology, and this goes to everybody saying how cannabis is the next big thing. Let's look at a weekly chart. Yeah, these stocks, I mean, there was some euphoria that came out with these. Remember Tilray going all the way up to 300. But the fact of the matter is that MJ, which is the broad ETF for these, is at 3.5-year lows. You cannot argue with price. You cannot argue with the psychology. You can't hope that it comes back because it's going to be legalized. The fact of the matter is that this has rolled over, and look how it tries. Every attempt to try to get back above the declining 21-day exponential moving average is met with people hitting the exits. It's that simple, and that's why the 21 is so important to us in-house here. So that is that's an example of using the 21 in psychology. Let's talk about stochastics a little bit here. I've been using them more in my videos, and I want to use this link that I have to just talk a little bit about what the stochastic oscillator is. It's a technical indicator used to predict turning points, the end of a trend, the beginning of another. We've already showed how what's overbought and oversold, and pretty simply, it's a momentum indicator. It compares the most recent closing price to the previous range over a certain period of time, and it uses a 3-day moving average. So back to the chart here, the moving average is the thick blue line. The price is the black line. So when you get across up through the moving average, and let me use an example of something that was coming off oversold and made an entry in this case, gold, very nice entry, 140 support here. And when you can combine it with being oversold and coming off of oversold with coming up through a resistance area, it's a very good low risk entry point. And yeah, we're giving back some gains on gold today. But again, if we're wrong small. We got in at 141, we'll be out at 139-ish if it breaks the 50-day moving average. Very minimal loss. And you can see the way some of the spikes on this momentum work. Sometimes price corresponds with it, sometimes it doesn't, because it has to do with the range and the formula that stochastics are using. But the bottom line is that very similar to the way Tim uses the ATRs in his video, how not to make entries when you're overbought and how to try to wait until you're down here at or below the mean or oversold, and then coming off of that oversold area gives you such a better low risk entry. And this is not something that you see people whenever they show MarketSmith charts using quite a bit, but it's especially, I use it less when we're in a strong trending market, but it's very important when you're in a range bound market. And speaking of range bound markets, let's go back to this S&P 500 here, and you can see going all the way back, here's back to September of last year. The market has had a severe correction, a mild correction there, but we've basically gone nowhere over the last year. We're exactly where we were now. It's a big range bound. We're in a range here. We're in a tight range here. We're in an uptrend here. But when you're in a range, it's even more helpful to focus in on your individual stocks and not buy something that's overbought and is also at the top of the range. When you're range bound, you want to try to make your entries at the lower end of the range and possibly take some offensive profits when you get closer to the top of the range. So that's the stochastic indicator. Let's talk about some in-house positions that we're still holding now. I mentioned 5 in the Grotection portfolio, and yeah, shutting down that streaming data certainly did help some things. Here was a gap up on earnings, came back, and it tests the 200-day moving average. A little bit of a move up coming back here, and as the oscillator is working off this oversold range, remember stocks don't go up forever, it's holding this 21-day exponential moving average, which is very healthy as long as it continues to hold that. When it hopefully comes down and coincides. This may not come all the way down. Sometimes it doesn't if it's a very strong stock, doesn't ever make it to oversold, but this is acting fine after a nice gap move up. And then SBAC, this was another stochastic buy coming out of oversold here. So a nice low risk entry. We're about flat on this right now as it's some selling going on in this area today too. But again, low risk entries. Also, GLD, we're long in Grotection. Very same situation with the entry back in coming off of oversold with the stochastics. GDX, same situation. Coming up off of oversold, coming through a moving average with stochastics now trying to hold this 21 and 50-day confluence. RSP still long. as this is holding the 21 and the 50. And then yesterday, when the QQQ, the portfolio was in QID, which is the double inverse of it. But when we broke this 189 area yesterday, notice how 189 was resistance, resistance, resistance. On the way up, got back above it, held support, tested and held, and then finally broke below it. So this key 189 area, when this was broken yesterday, I took an entry into QID. I don't use the QID chart to make my buy and sell decisions. I'm making them based on, because this is a derivative of what the QQQ is doing. So I'm making my buy and sell decisions on what's going on with the QQQ. And you can also notice that when it broke that area, the QQQ was coming off of overbought conditions. So that gives a little more reason to a little more weight as far as entering the short position, because the stochastic is working in your favor also. Let's take a look at some blue chip income holdings. NEE, we've held this. This one even survived the sell-off of last December. It's been so strong, and this is the top holding in the blue chip income portfolio. This is a utility that pays a nice dividend. NEE, we also own ABT. This is one of the weaker ones in the portfolio right now. Had a good run, consolidating right now. It's oversold, and as long as it holds the bottom of this range, we'll continue to hold it, and it's still above the 200-day moving average. The blue chip income portfolio takes a longer time frame than the Grotection does. It's a good owning the two of them is a good combination, because one tends to zig when the other one is zagging, and I'm a big fan, and so are clients, of a smooth equity curve. So when one's underperforming, usually the other one is outperforming. Also own Lockheed Martin. Have held this for a couple of months. Bought this breakout, and this has been continuing to trend nicely higher. Notice all pullbacks are being held by the 50-day moving average. So if this would break the 50-day, that would be a change in character and probably a time to lock in some profits. CVX. This is a diversified portfolio. We try to hold something in all of the major 11 spider asset classes, but this is just trading in a big range. 63 relative strength is one of the better ones from an oil. Compare that to the XLE chart that I showed before. Big difference between CVX and XLE. So we try to find the finest stock, the strongest stocks across the broad sectors. Costco, a recent entry into this portfolio, pulling back and holding the 21 and the 50-day moving average right now, Costco, and it's also on oversold. So if this hooks back up, that would be a nice low risk entry for some new client money that comes in that doesn't own it yet. So again, combining stochastics with moving averages and low risk entry points help to put the odd in your favor. AMT, American Tower, this is something that, again, made it through the correction. This was held all the way through the correction. Look at the nice price action on this while the market was selling off 20%, and then continues just to trend higher, pull back. This lot of not necessarily high beta stocks, but high stocks with big gains. This got hit hard during the sell-off and the rotation into oil and financial value stocks a couple of weeks ago, but back above the 50-day moving average, and again coming off of an oversold stochastic similar to SBAC. They're in the same group. And then the rest is some ETFs that we own. For example, NOBL. This is a Dividend Aristocrats ETF. Nice relative strength during the recent sell-off, continuing to trend up, holding the 21-day exponential moving average. So that's it on the education. If you want to ask questions now, I'd be glad to take your questions. I did get a couple of questions in advance, and I'll address them first. Let's see, what will the effect on the markets be of all this impeachment talk? Will we have a major meltdown? Nobody knows for sure. I think that my personal take on this is that there is a Trump premium in the market because of his business-friendly his business-friendly approach to the economy. We'll take our cues from the charts, not from the impeachment talks. We're in a rally right now where what led it has failed miserably. There's been some rotation into financials and value stocks. Those don't typically lead big gains, and that's why we've been on the underinvested side here at Revere. And the good thing about the market is we're still firmly above the 200-day moving average. That all the damage tends to be done below the 200-day moving average. One of my key 13 rules is to not be exposed when you're under the 200-day moving average, because the average of the market on a monthly basis is negative 0.88% when you're below the 200-day moving average versus, I don't recall exactly what the monthly positive gain is when you're above it. Another question, I heard you and Tim talk about overbought and oversold on the podcast. Can you show me what that looks like? Very similar to what we're showing on the stochastic here is Tim's ATR charts on the videos, where he charts the mean, which is the 21-day exponential moving average, and then 3 ATR above and 3 ATR below leads you to understand where a stock is relative to its recent action. Same situation on the stochastics here. Next question, the market seems very choppy and I keep getting smacked around. How do you handle this volatility? By trading less and taking smaller positions with wider stops. You also need to make an effort. Let me bring this chart up here. Depending on what market type you're in, uptrend, consolidation, and downtrend, these are the types of buys and sells that work. If you're not in a firm uptrend, don't buy breakouts, they fail. During a consolidation, you either want to buy at support or take profits into resistance, very important. And if you go into a protected downtrend, you can sell at resistance and also sell at breakdown, but it's only during uptrends when you want to buy breakouts and buy at support levels. What's your favorite stock or emerging group now that you expect to lead the market? The leading groups have been banks, and this really just started a couple of weeks ago with the trend out of value, into value from momentum stocks. Here are two ETFs to look at. This is the momentum ETF. You can see how relative strength just fell off a cliff 2 weeks ago after this nice run. This is I don't really ever recall seeing something as violent over a 2 to 3 day period as we saw 3 weeks ago with this momentum sell-off, and then corresponded with the move into, this is the value ETF. See how the relative strength, how money just flowed into it, and now this is regressing to the mean a little bit, also coming off of oversold. But what's leading right now is value stocks. Oil also got that big run and that big gap up on Saudi Arabia, and it's given most of that back. But really what has been holding up the best has been the SOX is the one area of tech that for the most part has been still holding up okay. You can still see it trending. So it's software type stocks and FANG stocks have been underperforming, but the semiconductors have been holding the QQQ up. So semis are like the last tech area still standing. And really gold and silver, since they had this breakout a couple of months back, have continued their intermediate term and long-term trend above the 50-day moving average and the 21-day exponential moving average. No rally can be led by gold and silver. You can have a percentage of your portfolio allocated to it to take advantage of it. But that's what's leading the market right now. Let's see some of the questions that came in. Do I watch various nation ETFs? Yes, I do. India had been failing miserably. They just passed a big tax reform package. You got a gap up into the 200-day moving average, so we want to see if that was a 1 or 2 day wonder or if it's going to change things. China is ASHR. China stocks have been acting better recently. You can see the relative strength on them, forming this double bottom pattern, but unable to get above the pivot. Coming back to oversold now into a moving average. So if it comes off of oversold and blasts off of this moving average, it could correspond with a China deal. That would be a good entry into China. EWG is Germany. This has just been so-so lately. Relative strength at a 38. Really, all of Europe hasn't really been that great, and I know that the economies are weakening in the rest of the world before the United States. But VXUS is the broad ETF that tracks all developed nations, and you can see they've had a little bit of a nice run over the last couple of weeks. But relative strength still at a 46. Compare that to the relative strength of the S&P 500, which always hangs right around this between the high 60s and low 70s area. So yeah, we don't buy individual country stocks very often unless something is really standing out, but we do watch them. Let's see, PAGs, no base. Let's take a look at PAGs. Yeah, this had a nice run out of this gap up out of a stage 1 base. This is if the market's working, gaps out of stage 1 bases are at the top of my list of things to buy. This had a nice run from 32 all the way up to 48. So that's a 50% run in less than 3 months. Some give back is natural to happen. Had another gap up here, but this also got hit. I mean, it's just a function of what happened with the market, people taking profits very quickly on things that are acting very well. Now you see what's happened. It's caught the 21 exponential average rollover flu, and anytime it tries to get back above it, it's immediately sold off. So yeah, I don't like to hold anything that's declining below the 21-day exponential moving average. Maybe a half position if I've got nice gains in it. Big support on this is this 42-43 area. The 100-day moving average, which is this purple line, might be the next place where it comes to. But quite simple, this area has fallen out of favor. iPay is the ETF that corresponds to the card payment sector, and I'll take a look at the charts of all these stocks, but every single one of them, Visa, MasterCard, American Express, PayPal, they all topped about the same time. And you can see the relative strength on iPay really starting to go lower, starting with 5 weeks ago. And that coincided with the PayPal gap down the PayPal gap down on earnings was a little bit sooner than that. We held PayPal. We got out of it after this gap down on earnings. But notice Visa and MasterCard are also catching this 21 EMA rollover flu, unable to get back above it. Visa, MasterCard can't get above the declining 21. American Express can't get back above the declining 21. Everything that is really, and Square's in the sector too. Square got hit even harder sooner. You can see that the Square and the PayPal gap down happened about the same time, unable to get back above the declining 21-day exponential moving average. So PAGS is in that group, and that's what it is. You've got the market, you've got sectors, and then you've got stocks within the sectors. Would I say Roku had a climax top? Yeah, absolutely. With that big negative reversal day. We're slowing down again. That big negative reversal day, and the way it was trending up, and then this gap up day, it got back above it. There's an ONeill Rule. I think it goes on a weekly chart, but yeah, this was kind of climactic, and then the final gap up and then reversal. I would have sold half if I'd have still held it here. Probably would have held half as long as it held the 21, but once the 21 hit and then the rollover into the 50-day, you can always buy it back, people. Remember, there's nothing that says you can't buy something back after you own it. And if you'd got out here in the 140 area, you'd feel a hell of a lot better than still holding it down here at the 100 area. Advanced decline line. Yeah, I pay some attention to it, but I don't really focus a lot on it. Let's see. Somebody asked about ABR. This is a REITs are acting well, and this is forming a very nice base. This is the best that you can hope for in what the market had been doing, and the focus out of growth stocks. We're a growth shop. We also hold a blue chip income portfolio because when some things are out of favor, other things are in favor, and growth stocks are not in favor right now. Is Amazon dead money, or will it come back? Good question. Amazon finally broke the 200-day moving average yesterday. There were some red flags with this one, starting with its bad reaction to earnings, and then it kind of caught the 20. This was more the 50-day flu than the 21 flu. Couldn't get substantially above the 21, and now in the last week we got a downgrade. The 21 has rolled over, and it broke this black line, the 200-day moving average, yesterday. We stopped our position out when that happened. It's coming down into the oversold area. We'll see what happens when it gets there. But after this sell-off, after earnings, it never recovered from a relative strength standpoint. Then relative strength declined again over the last couple of weeks, and now you're below the 200-day moving average. This chart isn't really broken. I wouldn't say it's dead money. They've got an earnings report coming up in a month. That will go a long way, but things changed in their last earnings report. You can see look at the big earnings growth, 999, 181, 117, 3%. Are things slowing? Is the growth in their Amazon Web Services slowing? Again, selling takes place on the charts before it takes place on the fundamentals, but this stock has really only gone down about 12%. It topped at 2035. It's at 1753 now, but once it broke the 200-day, we're out, and you've got all the moving averages rolling over. Don't know if it's dead money, but it's certainly not in favor now, and really none of the FANG stocks are in favor. The best acting ones, well, that's not true. There are some that are still acting well. In fact, Google's acting well. But the ones that made the significant gains, like Amazon, since their last earnings report, hasn't been acting well. Google's acting okay. Facebook, again, stuck with the declining 21 and 50-day moving average, unable to get back above it. I showed Netflix. Apple still working. Apple's still fine. QQQ overall is lagging, though, between the software stocks and some of the weakness in the FANG stocks. It's subtle, but the rotation out of the high beta stocks 3 weeks ago started to hit it, and it's been trending down over the last couple of weeks. You want the NASDAQ to be leading, plain and simple. Here we're looking at the QQQ, broke the 50 and the 21 yesterday, and right back into the 50, but can't get back above it. The 50-day moving average is at 189.16. I mentioned that 189 area that held any tests of the breakout over the last couple of weeks, but now we're back into this area. So technically this is the failed breakout if we can't get back above 189 on the NASDAQ 100. I don't give individual buy and sell. I tell what we're doing. Somebody asked, should I dump this or that? I can't answer that question. Okay, any other questions? Let's, we're right about at an hour now. Let's take a look at what the TLT is doing, and then I think I'll wrap it up. TLT, really nice low consolidation area coming off of oversold, this big move up, topped here, then we started giving it back, and now going back up. We're above the rising 200-day moving average and the 100-day moving average. So bonds, this TLT is in a bull market right now. I don't predict where bonds are going, whether they're going higher or whether they're going lower. I just look at what's going on in the chart and take my cues from that. Any other questions? I don't see any coming in. This is the standard settings for stochastic. I think it's 14 and 3 is what they use on MarketSmith. All right, I think we're going to wrap it. Thanks everybody for attending. You will, if you registered, you'll automatically be sent the recording of this. This is our best show, our best turnout of the 4 that we've had them as far as live, and I've got a ton of people to send copies of the recordings to. So thanks very much for attending, and take care, and we'll see you in 2 weeks when we do the next one.